FHA loans are a type of government-backed mortgage that were first introduced by Congress in 1934 during a time when the housing market was in serious trouble and traditional mortgage terms were out of reach for most buyers. FHA stands for Federal Housing Administration. In 1965, FHA became part of HUD, the U.S. Department of Housing and Urban Development. Importantly, FHA does not lend money directly. It insures loans made by approved lenders, which allows those lenders to offer more flexible terms. FHA loans are only available for primary residences. They cannot be used to buy second homes or investment properties. The core purpose of FHA loans is to promote home ownership by offering more forgiving guidelines, especially when it comes to credit scores and down payment requirements. To this day, FHA remains one of the most accessible loan programs for buyers who have less than perfect credit or have limited funds for down payment, or even who need higher debt-to-income ratio flexibility. The minimum down payment for FHA loans is 3.5%, and this applies to 1 to 4 unit properties. For many years, FHA was the lowest down payment option available, particularly for multi-unit properties. That's one of the reasons it's still so popular today. In addition, FHA allows seller concessions of up to 6% of the purchase price, which can be used towards closing costs, prepaid expenses, and discount points to buy your rate down. Seller credits cannot be used toward the down payment. In some cases, due to how property taxes, prepaid items, and credits are structured, a borrower may bring less than 3.5% to the closing table. However, this is an important distinction. If you bring less than 3.5% to closing, you must still document that you have the full 3.5% available. That's a hard, non-negotiable FHA requirement. FHA loans come with 2 types of mortgage insurance. Upfront mortgage insurance. This is typically 1.75% of the loan amount, and it's usually financed into the loan. There's also monthly mortgage insurance, which is paid every month. This is typically lower than conventional mortgage insurance for borrowers with lower credit scores. Here's the trade-off. On most FHA loans, the monthly mortgage insurance lasts for the life of the loan. FHA interest rates are often lower than conventional rates, but a word of caution, some lenders inflate government loan pricing to increase their commission. Always compare rates and costs, not just the headline interest rate. For standard FHA underwriting, the minimum credit score is typically 580. Borrowers with scores below 580 may still qualify, but the loan will require a manual underwrite, which usually means lower debt-to-income ratios, higher down payment requirements, and additional reserves. FHA also has shorter waiting periods after major credit events compared to conventional loans. With a Chapter 7 bankruptcy, you can purchase 2 years from discharge, or 3 years if a mortgage was included. For a Chapter 11 or Chapter 13 bankruptcy, 2 years as well. For a foreclosure, 3 years from the date of the sale. There are extenuating circumstances and exceptions, but these are evaluated case by case and are not guaranteed. One critical note, if you have delinquent federal debt such as student loans or tax liens, that can be a deal breaker. FHA is also more flexible when it comes to debt-to-income ratios. In many cases, FHA allows DTIs as high as 56%, depending on credit profile, reserves, and other compensating factors. By comparison, conventional loans typically cap DTIs between 43% and 49.99%, depending on the borrower profile. FHA properties must be safe, sound, and livable. This is where FHA often gets a bad reputation in the real estate community. During the appraisal, the appraiser will note health and safety issues or deferred maintenance, such as peeling or chipping paint, missing handrails, broken windows, and exposed wiring, just to name a few. If these issues are noted, they must be repaired before closing. In some cases, a lender may be able to do an escrow holdback, which allows money to be set aside for the repairs to be completed after closing. Here's the reality. Many of these items can also be called out on conventional loans. It just happens less frequently. FHA isn't picky. It's simply consistent about safety standards. Because of the low down payment, FHA is extremely popular for house hacking. For 2-unit properties, FHA is usually straightforward. For 3 and 4-unit properties, there is an additional requirement called the self-sufficiency test. This means that 75% of the property's total market rent must cover the full mortgage payment. In higher interest rate environments, this can be very difficult to pass. Despite what you see online, buying a 3 or 4-unit property with FHA is not always easy or realistic. It's still a great strategy, but expectations need to match reality. Generally, you can only have one FHA loan at a time. There are exceptions, usually involving job-related relocation and significant distance between properties. If you refinance an FHA loan into a conventional loan and it remains your primary residence, you'll typically need to live there another 12 months before buying a new primary residence. If you're converting your current home into a rental and need that rental income to qualify for a new FHA purchase, the new property usually needs to be at least 100 miles away. If you already have an FHA loan and want to refinance without taking cash out, you may qualify for an FHA streamline refinance. This program typically offers minimal documentation, no appraisal, and a mortgage-only credit report. It's designed to reduce your interest rate or your payment with less friction. FHA loans are the most flexible and accessible mortgage options available. Understanding the requirements up front is what makes the difference between a smooth transaction and a frustrating one. If you learned something from this video, consider subscribing and following us on social media for more straightforward mortgage educational content. Thanks for watching.